Once you spot this at a support level, it is suggesting to you that the market wants to go up. So initially you have the market coming down from wherever it is coming from, like this. So that's the market coming down. Then it gets to the support level. That's a reversal zone. It has to give you a signal before going, and this is one of the signals, a bullish Harami pattern. So once you spot this at a key support level, and like I said, don't worry about support levels. We'll teach you next week. Once you see this at a support level, you should be looking to buy. So let's look for examples. It is also quite common. Now, unlike the bullish engulfing patterns, when you see a bullish Harami, that after that one forms, you can still enter the trade. You can enter on the next candle. Reason is the market is still in discount price. So if you are buying there, you are not buying at a bad price. So you can enter on the next candle. But with the engulfing patterns, if you enter on the next candle, you'll be entering at a bad price. That's why you have to wait for it to come back. But as far as Harami is concerned, you can buy on the next candle because you still be in a discount at a discount price. So let's look for an example. It's also very common. We already have an example here. Look at a support level. These things are very common. So train your eyes to see them all the time. I'm talking of these two candlesticks. This big red candlestick and this small green candlestick. This is what I'm talking about. So what happened? Did it occur at a support level? Yes, it did. At a support level. Now, if you're wondering what TSBM means, it means turtle soup buy model. It's one of the things we'll be teaching you. One of the very, very effective buy strategies we'll be teaching you in our subsequent webinars. So look, after the engulfing, the Harami pattern formed, what happened? So this is a Harami. This big red candle and then this small green candle. So you could have entered here on the next candle. So immediately this one closed, you could have entered this trade here. And look, how many pips did it go up for? Assuming you entered immediately after the Harami pattern formed, taking it to the next support resistance level, you'd have made 294 pips by just knowing how to identify a Harami pattern. Now, if you're already trading, you know that 294 pips is not a joke. That's plenty money, especially if your account is big. That's a lot of money. So that is how a bullish Harami pattern looks like. It is very, very common. You will see many, many examples. I'm sure we'll even see some here again. Let's look for some. It is very, very, especially on the smaller time frames. This is another one. It's not a perfect example, but it's still an example. I'm talking of this. You see that. Now, where did it occur? Did it occur at a support level? Yes, it did. At a type of support level we call rejection block. You'll be learning all those things. That's the rejection block right there. That was a support level. So it formed at a support level, a type of support called rejection block. So once again, this is the pattern I'm talking of. These two candlesticks. So after the Harami formed, you could have entered on the next candle. So your entry would have been somewhere here. So when it appeared, how many pips did it go up for? Assuming you entered immediately after the bullish Harami pattern formed. And then you're looking to get out at the next resistance level. How many pips would you have made? About 256 pips. Now that's a lot of money. 256 pips is a lot of money. So you see how you can easily make some nice trades by just knowing these patterns. So if you understand these patterns, and you understand support and resistance, and you understand market structure and liquidity, come on, you are going to become a beast in trading. Yeah, you will do really, really well. And these are the basics, so you must take them very, very serious. So that is a Harami pattern. Let's look for one more, then we'll look at bearish Harami. It's quite common. I see another one here. But let me find out if it's opened, if it formed at a support level. Yes, it did. It did form at a support level. A type of support called, there are a lot of support levels, so different types of them that will be teaching you. That is called a breaker or mitigation block right there where I have drawn the green rectangle. So this is the Harami pattern I'm talking about. Look, you see a big bearish candle followed by a small bullish candle. So you could have entered the trade immediately after the Harami formed. So your entry would have been here. This would have been your entry where the arrow is pointing at. And where would you have gotten out? Here, which is a bearish breaker. And you'll be learning about that very soon. So don't worry, don't let these terms confuse you. You are going to know them very, very well. So how many pips would you have made on this trade? Assuming you entered after the close of this candle, up to the bearish breaker, you would have made 218 pips by just knowing Harami patterns. So this is serious. This is some really serious stuff. And I'll entreat you to spend a lot of time on your charts, identify these things, take screenshots, save them on your computer, and study them as flashcards. That is what I do. I still do them every day. Every single day, I prepare flashcards. They are on my computer all the time. Then I study them. If you don't become obsessed with this market, you will never understand it. It needs a lot of attention. That is, if you really want to know how to trade, then you have to spend a lot of time on the charts. It has to become your obsession. So when you wake up in the morning and pray, the next thing you should be thinking about is how to look at your forex charts. So that is it for bullish Harami pattern. Price is fractal. Please understand what I mean by price is fractal. It means whatever happens on the big time frames also happens on the smaller time frames. So these patterns I'm talking about, you will see them on the monthly time frame, weekly time frame, daily time frame, 4 hour, even 1 minute, you see them there. So you have to know how to break it down from the monthly time frame down to the smaller time frames, and you'll be taught, don't worry. So now let's look at the bearish Harami. How does that one look like? First of all, let's delete this. These things we are teaching you, they happen on all the time frames. All of them. That's why we always say price is fractal. That's what we mean when we say price is fractal. I have to take my time and delete them one by one. So let's look at the bearish Harami. That one is supposed to happen at resistance levels. I always like to use the color red for resistance. So let's change the color. So first of all, the market is coming from below like this. Then it gets to this resistance level. So how does the bearish Harami look like? I'll show you. It's a 2 candlestick pattern, just like its cousin, the bullish Harami. So first of all, we have this. Then it is followed by this. Note that I'm saying you must see them at a resistance level because it's a sell signal and we sell at resistance. We don't sell at support. We sell at resistance. So you must see it at a resistance level, a key resistance level for that matter. So you see this is how it looks like, a bearish Harami pattern. So once you see this at a key resistance level, you can expect this to unfold. You can expect the market to drop like this, like it's hot. Especially if it is occurring at a key resistance level. So this is how it's supposed to be like. So let's look for examples. Also a very common pattern. We will see examples. Yes, there's even one here. You see? It's very common. So look, it gave us a Harami pattern at a nice resistance level. I'm talking of these 2 candlesticks. This one and this one. That's a Harami pattern. So you could have entered this trade here like I did. You could have entered at this level after the close of that candle. If you entered there and you are still holding it because you know it's coming here to the next key support level like I did. I'm still in this trade. I'm holding it till next week. Then as soon as it comes here, I'll buy it again. You would have made how many pips? 182 pips. And you are still in profit. By just knowing Harami, a bearish Harami pattern. Look at it. Big bullish candle followed by small. We are more interested in the size of the bodies than the wicks as far as these patterns are concerned. We look at wicks when we are looking for highs and lows. But as far as these candlestick patterns are concerned, we are much more interested in the bodies of the candlestick. So this is it. A big green candle followed by a small red candle. Then we would have entered the trade here. It happened at a resistance level. Let's look for another example. I want one that appeared at a good resistance level. They are quite common. We will see a lot of them. I've seen one here, but it's not nice. So let's look for a nice one. I like to start with the simple ones. Some of them are more complex. But since it's new to some of you, we have to look at the simple ones first. And I see one here, also at a resistance level, which happens to be a bearish order block. If you don't know what a bearish order block is, don't worry, you'll find out very soon. That's a bearish order block. That is it right there. Now, what do you see? At the bearish order block or resistance level, big green candle followed by what? Small red candle. That's a Harami pattern. And it also formed another type of pattern we'll be looking at called the evening star pattern. We'll be looking at it very soon. So you see big green candle followed by a red candle. So you could have entered on the next candle, which is this one. So this would have been your entry somewhere here. Okay, so you'd have entered there and you'd have been looking to get out on the next key support level. Where is it? Right here. Don't worry, you will understand how to identify these support levels. So you'd have entered the trade here, then you'd have brought it all the way down to the support level, and you'd have made 324 pips. So you see, these are big moves too. These are the type of moves that can help you double or triple your account in a short space of time, and then you are taking very little risk. Forex is probably the only industry, or trading in general is probably the only industry where you can take very little risk and yet make a lot of money. And you can only do that if you are able to spot big moves. Like this move. If you had entered here, you would have had a drawdown. Drawdown means the trade moving in the opposite direction before it moves in the direction you analyze it to go. So if you had entered this trade here, you'd have had a drawdown of just 38 pips. And the reward was what? Right here, 318 pips. So 318 pips as your reward, 38 pips as your risk. So you were risking 1% of your account to make 8%. That's a 1 in 8 risk to reward ratio. So you'd have risked 1% in your account and you'd have made 8% profit on one trade. That is really good trading. You can only spot these things if you understand market structure and these patterns. And then liquidity, which you are going to know. We are going to teach you all those things.